Hello, everyone. I'm Lauren Vallier from GrowWise Partners. I'll let Janelle introduce herself here and then we'll kick things off.
Hi, everyone. My name is Janelle Doothraid. I am a corporate lawyer with Pulse Law. We're a corporate law boutique in Kitchener-Waterloo and in Toronto.
Awesome. So thanks so much to everyone that's joined today. We've got a really exciting session for you planned here today and lots of time for Q&A at the end, but also we've got the Q&A function set up. So if you have any questions throughout, just pop your questions in the Q&A. And if they're topical, we'll answer them kind of right as they come up. But also if they're kind of more general, we'll leave them to the end and answer all the questions at the end. So awesome. It's meant to be a really engaging session, so definitely just ask any questions you have and really trying to make this valuable for you folks here. So awesome. So a little bit about what we're going to cover today. So we're going to go with an overview of some financing rounds, what VCs care about, some due diligence red flags, and really just what to, prepare for before you start raising. And then a bit about the SR&ED side, so the scientific research and experimental development program and how to maximize VC dollars with those programs and other non-dilutive programs to kind of bring that round and bring those dollars farther. So I'll pass it over to Janelle to get into that side of it.
Awesome. So today you'll recognize that the session is kind of broken up into two sections. First, I'll take care of the legal section, and then Lauren will step in and tell you all about SR&ED. For the legal section, what we really want to focus on today is the due diligence red flags. But before we kick into that, I thought it would be helpful to explain a little bit about how financing rounds evolve and what companies can expect as you go through different financing rounds. So there are a few different stages of financing. At the earliest stages, we see pre-seed and seed. And at these stages, we're seeing angels or small funds invest in the companies. These are typically quicker deals. They often use convertible instruments like safes or convertible promissory notes. And the reason for that is because at the very early stages of company, it's hard to value the company and put a price on that. And so what safes do is they defer the valuation of the company. And investors will get their equity later, typically at a discount or at a valuation cap. And so the legal due diligence that happens at these early rounds is typically much lighter, and you're engaging angels in your network or friends and family. And so there's a bigger level of trust at this stage of what the company and the founders are like. And the company may not have really kicked off just yet. It may have just formed, and there's not a lot to really dig into with respect to due diligence. At the Series A is where we see the first major institutional round, typically where you start issuing preferred shares rather than safes or convertible notes. And in this round and subsequent rounds, like the Series A, Series B, and so on, investors are going to start getting rights such as liquidation preferences, anti-dilution protections, pro rata rights, and board seats. And so at this stage, due diligence becomes much more formal. At Series B and beyond, the focus shifts just from scalability also into compliance, and investors expect much cleaner governance, robust contracts, and risk management. And so we're going to cover today what due diligence looks like at that Series A and beyond stage, so that you can set yourself up for success right early on. So how diligence evolves, like I said, is at the seed stage, it's a quick review. We're looking at founder documents, incorporation. We might see a little bit about IP assignment as well. Versus at the Series A, we're looking at a full corporate overview to make sure all of your constituting documents are in good order. The IP is owned by the company, and making sure that your equity has been issued and documented properly, any equity that you've issued from the company. And then we're also going to be looking at your commercial agreements, employment agreements, and a little bit about compliance as well. And if you're organized early, even at the seed stage, you can make every future round easier. Despite the fact that at the seed stage, due diligence isn't too intense, I would still encourage you to give it your best and get everything organized early on, because as time passes and you eventually reach that Series A stage and diligence becomes more intense at that stage, it can become really difficult to go back and fix things or to remind yourself of what contracts were in place, what verbal agreements were in place that haven't been documented yet. And so I think one of the biggest takeaways I would want you to take away from this presentation is to start thinking about due diligence very early. And when you're just incorporating, that's the perfect time to start thinking about it and really making sure that you're dotting your I's and crossing your T's, getting everything documented properly, saved, and organized. It's really going to have a positive effect on your later investment rounds. So, what VCs want is really what we're here to talk about today on the legal side of the presentation. And venture capitalists and venture investors are, at their heart, risk managers. They're really excited to be investing in leading technology companies, but they're betting big on the upside and they want to make sure that they're going to see a return on their investment and there won't be any legal surprises down the line. So investors want to see that the company owns what it's selling to the investors and to its customers. The founders own what they think that they own. The cap table and corporate structure are clean, accurate, and up to date. If you've done prior financings, they want to make sure that you've complied with securities law because you don't want to find yourself in non-compliance with securities law down the line, and that there are no hidden liabilities or IP issues. Due diligence can be a little bit of a daunting process when you're the company. You're disclosing a lot about your company. It can feel vulnerable. You might be nervous that you haven't dotted every I and crossed your T. And let me tell you that I don't think I've ever worked with a company on a financing round where everything was truly perfect. But due diligence isn't about mistrust, but it is about clarity. Investors want to know what has and hasn't been documented so that they're making an informed decision and taking on this risk and investing in your company. You can imagine how a lead venture capitalist feels when they can point to a clean due diligence memo and say everything checks out, no surprises. But even then, like I said, no company really is perfect. And so when they can bring that due diligence memo to a senior partner at the venture capitalist fund and disclose transparently what the risks are and what they can do or what they can encourage you to do to fix those, that brings a new level of confidence that can really speed up closings. On the other hand, if a company has issued options without board approvals or failed to get the founders to sign IP assignment agreements, those small issues can create friction. As lawyers, we are, believe it or not, able to fix the vast majority of problems that we encounter, but it takes time sometimes. And so we want to encourage you to get ahead of the issues and keep everything clean from the start. And while we can fix things, I wouldn't want you to rely on that because fixing issues does take time sometimes. And so clean diligence isn't just about keeping your lawyers happy. There's a benefit to you and the investors as well. It shortens closing timelines, prevents diluting the valuation of the company, and it demonstrates discipline, which can give the venture capitalists and your investors a lot of confidence in you and strengthen the relationship that you have with them. So let's take a deeper look into actually what investors care about and examine during due diligence. And there are a few areas that we're going to focus on in this presentation. The first one, being a simpler one, is just the corporate structure and governance. So VCs are starting to look at, they want to confirm three things. Does the company exist as you've represented it? Do the founders own the company? And are there any hidden risks? So for the corporate structure and governance, we're looking at the incorporation documents, the bylaws, the shareholders agreement. We're looking at board and shareholder consents, authorizing past financings, an options plan if you already have one in place. Well, they'll be taking a look at your minute book to make sure everything's been papered and saved properly. And the corporate entity structure, especially if you have subsidiaries. Something I'm seeing in my practice right now is a lot of cross-border transactions. And we're seeing Canadian companies incorporate either a US subsidiary or a US parent because we are seeing an increase in US investors wanting to invest in US companies. And so they're still investing in Canadian companies, but during the investment round, we're doing some corporate reorganization to open up a US parent or a US subsidiary. And all of that goes to the corporate governance. So you want to make sure that you have those documents clean and well organized. One issue that can come up is if a company has issued preferred shares before amending its articles. So the articles authorize all the shares that a company is authorized to issue. And it can authorize different classes, so common versus preferred shares. And it also authorizes the number of shares that the company is authorized to issue. And so you want to be careful that the company's not issuing more shares or a type of class of shares that haven't been authorized yet in the articles, because doing so, those shares technically aren't legal. And so this is an example of something that we can fix. But if this is discovered during due diligence, when you've already met an investor, negotiated a term sheet, and we're at the point of doing due diligence, it's not great that this is coming up at that point of the negotiation and the investment process. For corporate governance, we would be focusing on shareholders' agreements and powers of attorney as well. One item that often gets overlooked is ensuring that every shareholder has joined into the shareholders' agreement and signed a power of attorney in favor of an executive of the company. And this matters because the shareholders' agreement binds everyone to the same terms, such as transfer restrictions, preemptive rights, drag along, and dispute resolution terms. And the power of attorney allows an executive, typically the CEO or the corporate secretary, to execute documents on a shareholder's behalf when closing a round or completing filings. And you can imagine when closing a filing, when closing a round, when you have two early stage investors, whether it's friends and family or an angel investor who's traveling while you're doing the financing round and they're unreachable, and you haven't signed the new financing documents. And without a power of attorney, it can be hard to move the financing forward and file, for example, articles of amendment, which would be part of the process without a shareholder's approval. And so a power of attorney can help save you in this situation where you have the CEO or someone else in the company be able to sign on behalf of shareholders. So this is one of the documents I really recommend companies get in place early on. We can move to the next slide, Lauren, and we'll cover capitalization and equity ownership. So corporate governance tells investors how you run the company, but capitalization tells them who actually owns it. And so investors are going to want to make sure that you have a verified cap table, that all the equity that you've issued has been properly approved and documented, in issuing your past equity issuances, that you've done so with the right approvals in place. And that you've been in compliance with securities law in doing so, especially the private issuer exemption in Ontario, and that the past equity that you've issued or the past options that you've issued are subject to a vesting schedule. In Ontario, you'll want to comply with the private issuer exemption as a private company so that you're not obligated to comply with the full suite of securities compliance obligations. To rely on the private issuer exemption, your company should have fewer than 50, well, your company needs to have fewer than 50 shareholders, excluding employees. You'll want to restrict the share transfers in your articles or shareholders agreement, and you can issue shares only to a permitted set of people, such as accredited investors, close family and friends, officers, and directors. You're going to want to do this. Otherwise, you'll have to file securities compliance obligations, such as filing a prospectus. And those securities obligations are quite onerous. And so it's a really great opportunity for small private companies, those who have fewer than 50 shareholders, excluding employees, to issue shares in a much simpler fashion. And if you lose your private issuer status, for example, issuing shares to someone who doesn't qualify, or by forgetting to include share transfer restrictions in your articles, every future issuance becomes more complex. And you'll need to, like I said, make certain securities filings. And so investors are going to be making sure in doing their due diligence on the company that you've issued all your past share issuances and securities in compliance with securities law. And a good, simple way to do that is to ensure that you're in compliance with the private issuer exemption. So good practice on this front is to keep a record of every share issuance that you make, the date, what exemption you relied on, and the category of the person. Is this an employee? Is this a close family and friend? Is this a director? And that will help you during the due diligence process. It's great to have a lawyer review your cap table and make sure that everything aligns in your cap table with what your corporate records reflect. This is a big compliance issue that we see in our due diligence reviews, is that the cap table doesn't reflect what the corporate records reflect. And so we'll do a little bit of review in that and make sure that we get everything reconciled on time for due diligence before the investor looks at it. And you'll want to make sure that all shares and options that you've issued have been approved by your board. We can move to intellectual property, Lauren. So for intellectual property, what investors are going to be reviewing are IP assignment agreements with founders, employees, and contractors. They'll be looking at licenses to and from third parties, and they'll be looking to make sure that your employee and contractor agreements include IP assignment. Investors want to confirm that the company actually owns its core product. This is a very, very important part of the due diligence process. And An example would be if an early developer never signed an IP assignment agreement with the company might not own its most valuable asset, being the code that underlies the company's product. And in licensing agreements, investors are going to look for exclusivity terms that prevent the company from fully exploiting its own IP. You don't want to sign off an exclusivity provision or clause that gives another party exclusive use of your IP. Sometimes we see these in limited geography regions, and that can be acceptable for sure. But you want to make sure that you can terminate that agreement if you need to, or that it's for a limited term. Other examples include termination on change of control clauses that can kill a deal, as well as undefined or perpetual royalty obligations that can eat into your company's margins. We can move on to commercial contracts. So just as part of the due diligence process, investors might ask you to disclose your customer contracts with some of your top customers. That's typically decided by revenue, but there might be some other metrics as well. You'll be asked to disclose key vendor, reseller, and strategic partnership agreements. And what investors are looking for here are clauses on change of control, termination, exclusivity, and assignment as well. So for change of control clauses that let a customer terminate if the company is acquired, create uncertainty around revenue. The investors might not be confident that you'll see that revenue down the line. And if that's a top customer agreement, then that can be a major red flag for an investor. And investors are going to flag this quite early in the diligence process and ask that you rectify that. Other important clauses in these agreements include the termination clause. Sometimes we'll see a termination for convenience on short notice. And that can make a 3-year contract worthless. If you think that you've entered into a 3-year contract with a key customer, but they can terminate for convenience with just say 30 days notice, that can be a big hit to your revenue. And so investors want better predictability in making sure that your customer contracts really support the future of the company's growth and not just what the company has grown to date. Other important clauses include the exclusivity clause, which we talked about before. So exclusivity, like I said, I do see from time to time. It's relatively common, but you want to keep it limited in scope so that investors aren't worried that it can block the company from serving other customers or entering into new markets. And for the assignment clause, ideally contracts should be assignable without consent. Otherwise, every contract will need to be re-signed upon an exit, which can jeopardize future acquisitions. So investors are looking not just at what the company is today, but what the company can grow and scale into. And so if you have customer agreements that require that cannot be assigned without consent, that can pose a problem if you seek to sell the company down the line. Best practices here for commercial contracts is to maintain a contract summary sheet summarizing the counterparty, the revenue, the expiration, and the key clauses for change of control, termination, or assignment. I know that this can be a lot for you to summarize. You can engage a lawyer to help you review this and keep everything in a tight spreadsheet that is easy to disclose during due diligence and helps flag red flags early on. And you can try to standardize your agreements as much as possible so that you have very little variation that needs to be unpacked during investor due diligence. We'll move on to employment agreements. Employment is a really hot issue in due diligence as well. So investors are going to want to look at your employee and contractor agreements. They'll want to make sure that those agreements have IP assignment and confidentiality clauses in place. They'll want to review your option plan if you have one and any options that you've granted to date. And really important is the misclassification of employees as contractors. This is tempting for a lot of small companies because when you hire employees, that comes with a lot of obligations on the company to comply with employment law. And here in Ontario, employment law does tend to lean in favor of employees. I'm not an employment lawyer, but I can give you a high level of some things that the courts will look to. So it doesn't matter if the company calls what I'll say the worker an employee, and it doesn't matter if the worker calls themselves an employee. At the end of the day, in the event of a dispute, the courts are going to look at the actual essence of the relationship. And some factors they'll look to is who solicited who for employment. You know, did the company post a job advertisement? and solicit resumes? If so, that leans towards seeing the worker as an employee. Does the worker provide their own equipment, or did the company provide that equipment? How integrated into the workplace is the worker? Are they part of the Slack channels? Do they share an office with everyone else? Are they at the company Christmas party and other things like that? Does the worker take direction from someone more senior at the company, or do they set their own vision for the work that they produce, including their own hours and being able to choose their own vacation time? So those are some of the factors to consider. I would strongly discourage you from trying to classify your employees as contractors. This is going to create a big mess down the line. And at the end of the day, while it's totally appropriate to hire contractors, and I see it all the time, and there's a good way to do it, if you're unsure if your contractor is actually an employee, I recommend talking to a lawyer because it's going to create a really big issue down the line. And investors want to see, with respect to the IP assignment and confidentiality clauses, investors want to see that every person who's built a product for the company has assigned their rights to the company. And it's one of the very first things that the investors' councils are going to look for. Best practices on this front is to use standardized agreement, keep all your signed IP assignment and confidentiality agreements in place, and ensure options are being granted under board-approved plans and priced properly. And it's great to do this at onboarding when you're hiring a new employee, to have, whether they're clauses that are embedded, IP assignment clauses and confidentiality clauses that are embedded within the bigger employment agreement, or you might want to paper separate IP assignment and confidentiality agreements that you send the employee at the same time that you're sending them their offer or immediately upon onboarding. It's best to deal with this all at the get-go rather than trying to clean up the mess later on. Lastly, on the due diligence red flags items, I'll talk about compliance, litigation, and liabilities. This is something we see a bit more later on than, it can come up in Series A, but as the company scales, it becomes more and more important. We don't expect too much at the earliest stages of a company, but what investors are going to be looking for is whether there's any pending or threatened litigation against the company, ensuring that you're in compliance with tax and that you've made all your tax filings. Data privacy compliance is a big one as well. It's a big one to comply with, and there's a lot to do on data and privacy compliance. It's a growing area of law, and obligations on companies are only increasing. And they'll want to make sure that you're in compliance with securities law as well. As I talked about before, most relevant to you is probably going to be the private issuer exemption. And so. Best practices here is to keep and complete a compliance checklist with respect to your privacy, employment, securities, and tax obligations. Of course, that's a lot to do, so a lawyer can help you with that, or at least help you get a checklist in place. And you're going to want to resolve the small issues early. Small issues become big issues, and it's really great if you can clean up any issues with compliance that you're having before you introduce the investor to the due diligence process. So that it doesn't need to be disclosed, just depending on the representation that they're asking you to make. But where they haven't been cleaned up, it's very important to disclose known issues transparently to the investor and not bury them, because it's going to, well, one, it's not legal to lie to the investors and the representations and warranties you're making to them in the due diligence process. And two, they're going to lose a lot of confidence and trust in you, and they might walk away from the deal. So what we talked about so far, which is the corporate governance and structure, the equity and ownership of the company, the intellectual property, the key customer contracts, your employees, and compliance matters, form the majority of the due diligence process that you're going to see. And a clean record in each area can really make your financings faster, cheaper, and more likely to close. Like I said earlier in the presentation, lawyers can fix the vast majority of problems that you encounter in these areas, but it costs more money to fix them down the line than it does to deal with them upfront early on. And it also exposes them to the investors, which might have them lose confidence in you or delay the financing round. And so the best that you can keep these 6 areas clean and recorded well as you grow your company from the start. The cheaper your legal fee, the cheaper your legal fees will likely be, and the more confident investors will have in you, and the faster your financing round will close. So that's it from me, Lauren, and we can move over to the SR&ED portion of the presentation.
Yeah, thanks, Janelle. So much good information there. There's so much value. I know some of those things even went over my head, so I definitely would be asking you a couple questions after this if it was me. But yeah, really good information there. Thanks so much for the details, and it's obviously quite a complex process, so better to get ahead of it than to kind of be trying to catch up after the fact. And yeah, the investor community is pretty small, so you don't want to mess up your relationship with one because they talk. So better to be prepared before you go into that process whatsoever and kind of, handle it right from the beginning. Awesome. So I'm going to cover some shred stuff now. I wanted to do a quick poll on the shred stuff just to see where everyone's at with shred. I know there's, a lot of times in these conversations, some people that have never filed before or filed in a previous company or maybe are currently filing, maybe internally or maybe with a consultant. So I just want to kind of get a sense of the room and where people are at so that I can kind of better navigate the conversation and better handle kind of the conversation and how much basics to cover. Awesome. Give folks just another second here to put that information in. Just if you could please fill out the poll super quickly here. Awesome. So it's seeming like a good chunk have never filed before. So I will cover kind of some of the Shred 101, the basics, but also quite a few are working maybe on filing internally or with another consultant. So a little bit of a mix, but if you're someone that is really familiar with Shred, feel free to just tune out for, 5 or so minutes because I am going to kind of go back to the basics and cover some of the kind of Shred 101 stuff. So thanks for participating in that poll. Um, Here we go. Alrighty. So, SR&ED 101. SR&ED stands for Scientific Research and Experimental Development. It is a tax credit run by the Government of Canada. So, it is the largest tax credit and the largest funding program in general in Canada. It's over $4 billion a year. So, it's a huge program and it truly is the backbone of Canada's economy and Canada's innovation economy. So, what it is meant to do is fund innovation and technical problem solving in Canada. So, how it works is it's an after the fact refund. So you have your expenses go out the door for salaries, contractors, and material costs. At the end of the year, you file your shred claim with your taxes and you get a refund, a cash refund in most cases. If you're not incorporated or some other caveats apply, it might just be a credit to your account, but in 90% of the cases, it is a cash refund that it goes straight into your business bank account. That covers up to two-thirds of eligible R&D costs. So I'll explain a bit more about kind of what that means, but that's the gist of the shred program. So, who's eligible? Everything for Shred has to be Canadian. The whole point of the program is to keep innovation in Canada. So the companies must be incorporated in Canada. All of the work must take place in Canada. So the employees must be located in Canada and paid T4 salary. The contractors must be located in Canada. And if you're purchasing any materials, which I'll explain a bit more about what that means, everything has to be utilized in Canada. And so, as I mentioned, it's an after the fact refund program. So, a lot of companies come to me and they explain all about their business and they're like, okay, I'm awesome, I'm eligible, this is great. But there's a big difference between doing shred eligible work and being eligible for shred. Because shred is a refund for expenses, you have to already have those expenses going out the door. So if you're doing eligible work and you're solving all the problems and you're doing, meeting that criteria, but you aren't yet paying yourself a salary or paying your employees a salary, or you aren't yet paying a contractor to do that work, or you have no real material expenses, then there's nothing yet to be reimbursed through the SHRED program. So you do have to be spending money to get it reimbursed. SHRED applies to any industry: tech, pharma, manufacturing, biotech, agriculture. Truly any industry. Does not matter at all. It doesn't even really matter what your company does. What matters is on the day-to-day level, the work that you're doing. So we're actually helping a restaurant that's doing some food science innovation. We're helping manufacturing, someone building modular homes. Like truly, we have clients in every industry and some that you'd least expect there to be that research and development. But what matters is that you're solving problems. So for Shred, in order to be eligible, the work must aim to solve a technical problem, not a business problem, not a marketing or scaling or legal or any of those other kinds of issues. It really does need to be a technical problem in nature. So that leads me to the slide, which is what work qualifies. I know technical problem is very vague, so a bit more about what that means. So if you're creating or improving a product, process, or technology, and you're doing that experimental and systematic investigation, That is really the core of what SR&ED is meant to fund. So we kind of say SR&ED funds the struggle. Anytime you have a challenge in your business where you don't know what to do, it's not a clear cut and dry, follow an SOP, follow standards, follow something that's been done before. That's you're really facing a challenge and you have to try something and iterate and fail and learn and test and experiment. That is the core of the work that's going to be eligible for SR&ED. So a lot of times within a business, there's a good chunk of work that isn't eligible for SR&ED, those kind of standards of, say you're building a tech company, you've got a platform, building a website, building the basics of a platform for an experienced developer, they can do that in their sleep. That's not a technical challenge. If you're integrating AI in a really unique way and you're facing challenges with those integrations and addressing those kind of problems in a systematic way, those sorts of challenges are what would be eligible for SR&ED. So, in terms of what expenses qualify, I explained salaries for technical employees, contractors or consultants, any third party that's paid to solve problems, and materials. So, in terms of salaries, this needs to be technical employees. As I mentioned, it's not business problems. So, these employees do need to have a technical background. So, that's typically developers, engineers, designers, scientists, whatever your field of science is, um, someone that has the technical expertise in that industry. And for salaries, you can receive 2/3 of that salary refunded through SR&ED. So for salaries, it's the most lucrative portion of SR&ED. That's 2/3 of those salaries can be reimbursed through SR&ED. For contractors or consultants, those are folks that are paid to solve specific problems, and the exact same rules apply. If you're paying a consultant and it's a challenge that you don't know how to solve, but for that consultant, it's what they do every single day, and it's not a challenge to them, and you're just paying them because it's their area of expertise, that's not going to be eligible for SR&ED. Everything has to revolve back to that challenging problem solving and that iterative style of problem solving and that systematic approach. If it's a simple kind of standard operating procedure for that contractor, that's not going to be a SR&ED eligible expense. In general, when contractors are paid to solve those challenging technical problems, those expenses are eligible to be reimbursed at a rate of about 40 to 45%, does depend on the province, but it's around 40%. So back to Janelle's point, she was talking about the difference between contractors and salaries, and there's some legal, implications of saying that a contractor is a employee or vice versa. There are also some implications in SR&ED. So as Janelle mentioned, there's a lot of variables in that equation of whether to hire an employee or pay them as a contractor. But it is good to know that from a SR&ED perspective as well, it's also more lucrative to hire someone as an employee versus as a contractor. It's 66% versus 40%. So it's almost double, but 2.5 or 1.5 times as much reimbursed through SR&ED as an employee. And then for materials, this is really specifically to physical materials used and consumed in testing. So for a tech company, we always get this question like, does server costs or subscription costs or any sort of tech costs count? And that answer is a hard no. The CRA has defined materials as physical goods used or consumed in testing. So we're working with one company that's building modular homes. They're using thousands and thousands of dollars worth of lumber every year to do their prototyping and testing. Those lumber costs would be eligible as a material cost. So it is pretty specific to manufacturing or kind of those pharmaceutical or companies that have a physical product, maybe some deep tech or hard tech, but that's kind of not typically eligible for the software tech companies. I've got a couple examples here of what works because even with all those details, it still is a little bit confusing. So these are just some examples we see come up quite often. So for example, addressing security challenges while building a custom software, improving algorithms to process complex data sets in a new way, building and refining prototypes to evaluate the technical feasibility at scale, or designing custom hardware or devices to solve challenges that existing tools can't. So within all of these examples, there's three common problems. There's a technical challenge, there's an iterative problem-solving approach, and there's lessons learned. So you have to kind of approach each problem in your business with this framework of, is it a problem? Yes. Okay, what did it take to solve it? Was it, a bug that I just went and fixed a line of code and it's resolved itself? Okay, so that doesn't meet the iterative style problem solving. If it's a problem that required, that approach that, failing and trying again and learning and getting a little farther, then it meets, the number two. And number three is lessons learned. So did you learn something at the end of that process? And even if the process actually fails and you get to the end of the road and it turns out that, what you thought would work wouldn't work at all, and you have to completely turn around and go back a different route, it can still be eligible for SR&ED because you learned something. So the project does not need to succeed in order to be eligible for SR&ED. So, a bit more about the timelines and deadlines of SR&ED. So, throughout the year, you're documenting your projects, you're keeping track of what the challenges are, what specific investigation you're doing. So, if you're, addressing security challenges, what specific variables or what specific kind of problems in the code are you solving? And those sorts of things. So, what's the exact investigation? What variables? What's the result? What tests are you doing? How are you manipulating the problem? And what does that look like? And who's doing that work. The more information you have on tracking, the better. And then throughout the year, you need to be kind of keeping track of the who and the what and the how. At the end of the year, SR&ED is aligned with your fiscal year. So whatever your fiscal year is for your business, at the end of your fiscal year, you prepare your SR&ED claim and you actually apply for SR&ED with your business taxes. So SR&ED is a tax claim, it's a tax credit. The end result of what we prepare as consultants is several different tax documents that get submitted to your accountant, wrapped up into your tax return, and then filed with the CRA. So what we do at GrowWise and what kind of most SR&ED consultants do is similar to accountants. We work with you at the end of your fiscal year to prepare your SR&ED claim and then file it with your taxes. We have built software to support throughout the year in the documentation process, but I'll explain that a little later on. In general, you file SR&ED at the end of the tax year, and you do have an 18-month deadline to apply for SR&ED. So you have up to 18 months after the end of your fiscal year to apply for SR&ED. So let's say you have a December 31st year end. Actually, even if you had a, say, June 30th year end, it's not too late now to apply for the year that ended in 2024, June 30th. So that deadline for the year that ended June 30th, 2024 would be this December 30th. So you do have a year and a half after that year end to go back and apply for SR&ED. But the best practice is to apply for SR&ED with your business taxes right at the end of the year. And when you do that, you typically receive the refund from the CRA within 2 to 5 months. What that process looks like is in about 90% of the cases, the CRA will, 99 to 95% of the cases, the CRA will approve your SR&ED claim with your business taxes with no further investigation. They'll, review it and then process the funds. In about 5 to 10% of the cases, what happens is a SR&ED review or SR&ED audit, and those vary in complexity. I'm sure, some people here have heard horror stories of how complicated and messy those can get. It's like any audit. It really comes back to how prepared you are, how much documentation you have, and how much support you have to prove that what you're applying for actually does qualify for SR&ED and actually is eligible. So what that would look like is sometimes it's financial questions, sometimes it's technical questions, and basically you just have to prove to the CRA that the work you did does indeed qualify and is indeed you spent the hours you said you spent on the project. So in that 5 to 10% of cases, you do have to dive a little deeper into the project. And then once you prove to the CRA that yes, it does indeed qualify, they'll kind of take those results and then process your SR&ED claim as applied. So in the only case you wouldn't get the SR&ED claim is if you go through an audit and they decide ultimately that the claim isn't eligible at all. But the reason you work with a consultant or typically have some expertise on this side is to make sure that when you're applying, the work actually does qualify with it before you spend the time applying.
Lauren, we have some questions from the previous slide about
Yeah,
eligibility.
yeah, for
So
sure.
Renee is asking, do the payments made to interns count?
So, yes, the payments made to interns do count as long as they're located in Canada and as long as they're, doing the technical work. But there's kind of two cases. A lot of times interns are paid through grants or through my tax or through other funding programs. If you're paying them as a consultant, so if you're paying, for example, through my tax and you pay one upfront lump sum fee to my tax, that expense is eligible as a contractor expense, even though the interns may kind of technically be employees. If you're paying them in one lump sum to a third party like my tax, that would count as a contractor expense. But if you're paying them and they receive a T4, and then they count as an employee, which therefore they would be eligible to receive the refund at the rate of 2/3.
Okay.
But they are eligible as long as they're doing eligible work.
We have two more questions. They're quite related. So one is asking, I'm a tech founder, and if I pay myself a salary, is that eligible? And the second one is quite similar. If the CEO is also doing R&D work at the beginning, even though the title doesn't reflect a technical role, can the salary
Mhm.
be eligible?
Yeah, definitely. Thanks for translating the questions there, Janelle. I can't see them on my screen, so I appreciate it. Yeah, so as a founder, you are eligible to receive SR&ED for a salary that you pay yourself. There's a small caveat there. The CRA has deemed that any founder or anyone who owns a portion of the business, a significant chunk, if it's a small amount to a technical employee, that's okay. But if you're a significant, controller of the business, you're eligible to receive SR&ED. You can only claim that up to 75% of your time is spent on technical problems. They've said, if you're a business owner, guaranteed 25% of your time is running a business. You can't say that 100% of your time is eligible for SR&ED. Even if it was, it happens sometimes with early stage founders that are paying themselves really to build that product in the first couple months or couple years. But the CRA has just put this ground rule of if you're a specified employee, as they call it, you're only eligible to receive kind of a maximum of 75% of your time as eligible. So then you'd receive a rate of two-thirds on that 75% of your salary. So it equals out to about 50-55% refund kind of maximum for founders. But yes, you can receive SR&ED for those expenses as long as it's not dividends. Dividends are not eligible for SR&ED, only salaries. Salaries that are taxed above board, you've got a T4 for it if you're just e-transferring between accounts. People ask me that sometimes. Unfortunately, if it's not, on paper, it's not legal, it's not eligible for SR&ED. Okay, awesome. So I'm going to get into kind of the doubling your VC dollars and maximizing your SR&ED and some advice on that. So if you were one of the folks that kind of tuned out for the SR&ED 101 session, tune back in. So we're going to go over kind of an example SR&ED situation. So we're going to talk about hypothetically, you raise $1 million. Use that money to hire two new technical employees, paid $100,000 each, $200,000 a year total. Pretty reasonable for hiring, two developers or engineers. In that first year alone, if those employees are working on SR&ED eligible activities and technical problem solving, which most oftentimes, in an early stage or growth stage startup, those folks would be fairly, most of their work would be eligible. You'd receive 66% of their salaries back through SR&ED. So that's $132,000 cash back into your account after your fiscal year end through your SR&ED refund. That translates to that original $200,000 investment equaling $330,000 with SR&ED funding. So truly, you can almost double your VC dollars or any dollars you have, but it's really important with VCs to note this is that with that SR&ED refund, you can really double those dollars. So over the course of 5 years, if you have $1 million put towards salaries, that's $660,000 covered by SR&ED. And this only costs you $340,000 total out of pocket to hire those technical employees for 5 years. So SR&ED really is so lucrative in these situations when you start paying technical employees, significant salaries to start doing that work. And it's really important that you know this before you start these conversations with VCs because they're going to ask you what your plan is. And if you don't know or don't know how much is eligible, it's just a complete red flag. So a bit about what VCs want to see for your non-dilutive side. So they really want to see that you're maximizing your SR&ED claim and filing every year on time. I mentioned there is that 18-month deadline. That really is meant for companies that didn't know about the program or maybe didn't apply in their first year because, whatever reason they got busy or didn't apply. But it's meant to kind of go back, sure, you didn't file it last year. Let's file that one. But then going forward, let's file every year with your business taxes so that this application goes smoother. It's straight away. You don't have to go back and amend your tax return. It's with your tax return straight away. It's simple, it's clean, and that simplifies the whole process for investors and for your company. You really also need to know your non-dilutive cash flow forecast. You need to be able to, forecast when SR&ED is going to be coming in, how much that's going to be year over year, and what you're going to be using that SR&ED refund for. Yes, a dollar is a dollar, but when you're given $130,000, 200,000, even $50,000 back through SR&ED, VCs want to see that you're reinvesting that into innovation. You're not spending that, on ads or marketing. Sure, a dollar is a dollar in your bank account, but it's really keen and VCs like to see that you're using that to further grow, further, expand your innovation. So know how much is coming, know when, know what. And that's kind of the last point there is that you've explored every option. If you're going to VC and asking for their money, you want to make sure that you've explored all other options and really if you can't apply and if you're not eligible, you know why. They're going to ask you, what's your non-dilutive funding plan? Most companies in the tech space, most companies in Canada in general that are innovating are applying for SR&ED. So at a bare minimum, you should be applying for SR&ED. And if you don't apply for SR&ED, there's a specific reason you should know that off the top of your head. And other programs like IRAP or MyTax or OCI or any other grant funding programs, you should investigate those programs and identify if you are eligible. Amazing. Let's do that. Let's get the funding in. If you're eligible and you just didn't apply because it's, a lot of work and it's too much of a headache, that is going to be a red flag for investors. You're asking for their money, but you haven't explored, haven't been scrappy and got all the funding that you can independently. So really try to explore all those non-dilutive funding options. And at GrowWise, we just do SR&ED, but I'm very well connected within the non-dilutive space. So if anyone has any other questions about IRAP or MyTax, I can happily answer those. And then the last point here is working with the consultant. VCs like to see that you're working with a consultant. About 80 to 90% of companies that file for SR&ED do use a consultant. And there's a clear reason there. Business founders don't start companies to do paperwork. They start companies to innovate and solve problems and, address the challenge you built your company to solve. So VCs don't want to see you spending 30, 40, 50, 60 plus hours at the end of your year claiming your SR&ED independently and trying to do it in-house. They want to see you use accountants, use lawyers, use SR&ED consultants, hire those expertise rather than trying to be an expert at everything. And then it's done right, and it's done well without you investing your time. Let's just let you focus on running your business. So a little bit about the maximizing SR&ED for growth. There's kind of four key points here. It's really important to understand where and when projects get identified as SR&ED eligible. So as annoying as it is, and I know both Janelle and I have mentioned a lot of things that are really pivotal to your business today, that things that you should kind of have in the back of your mind at all times. Unfortunately, kind of par for the course being a founder, we're asking you to have like 1 million tabs open, but that really is the reality of SR&ED. SR&ED needs to be an integral part of your business, and you do really need to be thinking about this all the time. The more education your company has, the more education your team members have, your developers, your engineers, the folks actually doing the technical work, the more they know about SR&ED, the more they'll be able to track, therefore the larger the return, therefore the more growth for your business. So it is one of those things that you really should be thinking about kind of throughout the year, and your whole team should be aware of what SR&ED is and what is and isn't eligible. So be clear on who identifies the projects and when. Is that a monthly meeting where you identify, challenges that are happening if they are or aren't eligible and who's documenting and what? Or is that kind of an ongoing basis? Just get clear on that practice. As I mentioned, the more data you have, the more SR&ED you can get. If you don't have time tracking, you don't have documentation of the challenges you face, you don't have any proof, if you are to get audited, it's a really tough battle to be able to explain that, yes, we did spend all this time. Yes, we did face all these challenges. They're just going to ask, okay, show me how you can prove that. So if you don't have clear time tracking, I would really encourage implementing some sort of time tracking solution specifically for your technical team members. And that doesn't need to be, minute by minute time tracking like consultants do. It can be on a weekly basis. What did we do this week? What percentage of my time was spent on these challenges? Kind of a weekly 10-minute activity exercise that will, give you enough information to be able to justify this SR&ED claim at the end of the year. And as I mentioned as well, there's strategy around SR&ED. Hiring employees is 2/3 of their salary. Contractors is 40%. So there's strategy around how to maximize your claim. If you're consistently hiring a contractor that could be an employee, you're not maximizing your claim. And then SR&ED efficiency, as I mentioned, is doing a SR&ED claim internally or working with a really manual and outdated consultant the best use of your time. A little bit more about GrowWise. We built an AI-driven platform to simplify the SR&ED process and to really save you time and effort in your claim preparation. So that's kind of our core value offering. We're service providers, but we've built this platform to expedite and simplify the process of preparing your claim. So we've built AI document review, document digestion, and AI project identification. So rather than having to go through manual meetings, you dump all of your data into our system and we pull out the projects that are eligible for SR&ED. And we can, maximize the number of projects, maximize the amount you're getting back through your return. So we have a strong team of experts as well as our platform. So we kind of call this solution supervised AI. Every step we've got AI as well as our team. So really with the goal of just simplifying this process for you folks. And so we've helped startups from, 2 people all the way up to 100 plus people companies. So we're helping across all different industries and sizes and really just trying to address the pain point that shred can be quite a headache. So we're really here to help simplify this process. And even if you're too early for shred, happy to have the conversation around, when's the right time and what you need to do now to start maximizing your claim going forward. And if you're working with another consultant, happy to give you a demo of our software and show you just kind of what we do and how we can help.
And at Pulse Law, we're a corporate boutique law firm. The vast majority of the team was trained at big law firms. I started my career at a firm called Fasken on Bay Street. And we're all really passionate about working with emerging and growing companies. We do a lot of venture capital and debt financings, mergers and acquisitions, and commercial agreements, as well as cross-border deals and international expansions. We have offices in Toronto in the Kitchener-Waterloo area, and our experience spans from Canada, US, and Asia. The firm's CEO was trained in Silicon Valley and spent many years there before leading a practice group in Asia before coming to Ontario. So we're all really passionate about working with emerging and growing companies. We're efficient and we're building out our own artificial intelligence tool to complement our legal services that we offer to our clients as well, so that you can ask your legal questions and get answers quickly, the kind of things that you wouldn't want to pay legal fees for. And we reserve, charging clients for the more, heavier lift of negotiating contracts and drafting. So yeah.
Awesome.
So, key takeaways from the presentation from the legal side, I want you to know that due diligence builds trust with investors. It's not a necessary evil, and it can affect your round. And so, many issues can be fixed, as I said in the presentation, but doing so delays the round, and investors might lose confidence or grow frustrated and ultimately walk away. And so, presenting a really clean set of records in that due diligence process can really impress an investor, earn their trust and confidence. And so to get ahead, you're going to want to keep your records clean from the start. And it's cheaper to engage a lawyer early on for guidance as you get those records together. Make sure you have your employees and contractors lined up, that you're issuing your options and your equity appropriately, and get the guidance early on so you can present your best case to investors rather than cleaning up the mess in the middle of a round, which is a lot of the work that I do. And I'll toss it to Lauren for the takeaways on Shred.
Yeah, yeah. So same with Shred, be clear on those processes and VCs do care a lot about how you're going to make one of their dollars into $2. So it matters a lot what your plans are for non-dilutive funding and it matters, who you're working with and how that process looks. So yeah, just make sure your claim is maximized and happy to be some support. We do free consultations as well on your claims and, offer support if you ever need help in understanding what that looks like. So yeah, here to help. And yeah, I just kind of wanted a quick call out there that I've worked with Janelle a little bit now and really, really knowledgeable. So if anyone here has any questions on the legal side, I would really highly recommend reaching out to Janelle. Just really a lot of wisdom there. So a great resource and Pulse Law in general. It's a great kind of up and coming law firm and they're doing a lot of great things. So it's a good team to get on with.
And I echo Lauren's sentiments about GrowWise. Lauren and I have been working together for a little bit now, and Lauren has a really great reputation in the community. And so I really recommend working with her for any of your shred concerns and questions and applications because she's clearly very knowledgeable about what she's talking about.
Thanks, Janelle.